Hello, with me today I have Michael Morris, Chief Executive of Picton Property Income, a real estate investment trust. Hi Michael.
Hi.
Thanks for joining me today. Look, to begin with, for those that don't know, could you please tell viewers what Picton Property Income is? What does it do?
So Picton is a UK listed real estate investment trust. That basically means it's listed on the stock exchange and has preferential tax treatment as a REIT. We own a diversified portfolio of commercial real estate assets. Broadly, 60% is in industrial warehouse and logistics. About a third of the portfolio is in office assets, and the balance predominantly in retail warehouse assets. And we own and manage those assets to really, maximise value and income on behalf of our shareholders.
You've got some famous customers as well.
Yeah, so we have around 400 occupiers in our portfolio, ranging from some very small, individuals through to SMEs, and then going all the way up to, FTSE 100 companies, the government, etc.
Yeah, I think some viewers might recognise B&Q on their DHL, those sorts of names that are instantly recognisable.
Yeah, very much brand names, and different assets attract different types of occupiers. And I'd like to think that we, work with big corporates and treat them in the same way that we treat smaller individual companies.
Okay, you've been in the UK commercial property industry a quarter of a century, so current conditions are perceived to be difficult. How does the market now compare with the past 25 years?
Quarter of a century makes me feel very old. But there's two things going on at the minute. One is the interest rate cycle, and clearly that has had an adverse effect over the last 12 plus months. And as interest rates and financing costs have risen, that's seen downward movement in property values. So that's difficult. The counter to that is that occupational markets, businesses, have been pretty resilient, in fact very resilient. And we've seen very strong rent collection across our portfolio. We continue to see occupational demand across different sectors to different levels, but broadly, across sectors there is occupational demand. So I think the period that we're in, to me, feels a little bit like 08-09, but not so severe. And the reason it's not so severe is that as a sector generally, there's less development. As a sector generally, there's less leverage. And the sort of wider economy, the banking system, etc., is far less pressured than it was back then.
Well, I mean, in terms of share price performance, in January 22, the REIT traded at its highest since mid-07. It's down a third since. Is that a reflection of some of the headwinds that you've explained, or is there something else at play?
Yeah, I mean, I think the sector as a whole has re-rated downwards since 2022, and you said, and that coincides very clearly with invasion in Ukraine, rising energy costs, rising inflation, rising interest rates. So that macro piece is weighing on the sector, and there is this difference between listed REITs, of which Picton is one, where the share price sort of adjusts instantly, and the underlying commercial property market, where the value of your assets is an estimate of price, and that pricing doesn't keep up in the same way that daily traded listed equities do.
Okay, how has the switch to flexible working impacted your portfolio? Are you more wary now of investing in offices?
I think the broad answer to that is we are more cautious, but we've also tried to address that change. So, flexible office working has come, as a result of the pandemic and, sort of lifestyle changes, and we need to adapt to that. So there's a number of factors at play here. There's, for us, we've introduced a proposition called Swift Space, which is aimed particularly at SMEs and offering them as owners of businesses more flexible occupation within our buildings. But I think what's quite interesting is that there has been, more of a move back to the office. You can see it this year versus next, but the way that corporates think about their office, their office use, they're using it more efficiently, and generally across the market where you are seeing companies relocate, more often than not, they're relocating to smaller premises rather than growing in size, and that has an impact on the market overall, and that's why we're more cautious. The other thing, I suppose, just in response to perhaps lower office demand generally, is that we're looking certainly for a number of our office assets about repositioning. You have a building, it's currently used as offices, but actually can that building be adapted, repurposed for other uses? And that's not possible in every scenario. There's clearly valuation implications to that, but we're looking certainly at the minute at both student and residential options on some of our office assets.
Okay, I mean the UK economy is currently looking vulnerable to a downturn with interest rates at a 15-year high, having risen so quickly in a short space of time. So in a recession, are there any areas of commercial property that will hold up relatively well, better than others?
Rising interest rates, is going to affect all sectors. It's a financing cost piece. I think we're more cautious on consumer spending and retail in the face of sort of rising mortgage costs, for example. We think industrial, tends to be a little bit more recession-proof, shall we say? The rent levels are lower. The sort of supply chain elements to it, much as we saw a little bit in the pandemic, that there's a sort of a need to that, and it's that sort of discretionary spending probably that's going to be hit first.
Okay, and you reported recently that discounts have narrowed across the industry, but Picton still trades at a big discount to net assets, as a lot of others do. So when do you see discounts returning to historical norms?
So I think a lot of the discount story is really driven by this macro picture. So I think, even in the last week, there's been a lot of talk about, rising interest rates, rising mortgage costs, etc. I think we need to start to see that stabilise, and that will bring, some confidence back into the market. Certainly at the minute, financing for real estate is more challenging, the cost of it being a key determining factor. So I think, that more macro position, particularly looking out over sort of medium-term financing costs, is going to have quite a big impact on the outlook going forwards.
And what's Picton's, what are the circumstances of your availability for funding in refinance?
Yeah, so we're in quite a good position actually, for a number of reasons. I think that the starting point is that the majority, and by that I'm sort of 95% of our debt is fixed. So rising interest rates isn't affecting our P&L in the same way as it would be had we gone for an unhedged strategy. So that's the first point. And then the second point is that our cost of debt, not only being fixed, is actually fixed for quite a long term. So we've got, the majority of our debt has maturities in 2031 and 32. So as a business, we don't have any meaningful refinancings coming up anytime soon. And again, that gives us, a really strong position, from a cost base to be able to run the business.
Okay, has the board of Picton Property been proactively buying back its own shares to rein in the discount, perhaps?
That's something that we haven't done through this last period. We're quite wary about buybacks in a vehicle where you have a difference between the underlying and how that's priced and the wider market. And I think if the discount were, dare I say, a Picton issue, then I think we would be looking at life quite differently. If it was down to sort of change in shareholder ownership or overhang through a changing register. But actually, if you look across the sector generally, Picton's discount is probably nearer the tighter discount than the wider discount. So I think we're alive to discounts. That's not to say that position might not change in future, but I think there's some bigger things at play that won't be dealt with through buybacks per se.
Okay, you talked recently about discounts across the sector and the case for consolidation and creation of larger diversified REITs. How do you see that developing over the next year or two? And will these, do you think, be smaller acquisitions, or will we be seeing some more large mega mergers like we've seen in other industries?
So I think the place that we're in at the minute is with a more challenging economic backdrop. The need to be efficient really comes to the fore, and our view is larger should lead to more efficiencies. And I think at a time where there is this disconnect between the share price and the underlying net asset value, gives boards, companies a bit more time for reflection on what they can do to address that. And our view has been for a long time that larger, more liquid vehicles, with a good performance track record will be better rated than those that don't have those qualities. And that's really our thesis behind that consolidation piece happening. And ultimately, if you can grow earnings through consolidation, that's a good thing for investors.
Great. Michael Morris, Chief Executive of Picton Property Income. Thanks for joining me today.
Thank you.